It does not begin with castles or kings. It begins with contracts, long ones, hard to read, harder to escape, across major cities in the United States and Europe. A quiet shift has been unfolding for more than a decade. According to housing market reports, institutional investors, including private equity firms, real estate investment trusts, and large asset managers, have significantly increased their ownership of single-family homes and rental properties. In some metropolitan areas, these firms now own thousands of properties. At first, the rise seemed like a recovery story. After the 2008 financial crisis, millions of homes went into foreclosure. According to government data, housing prices collapsed, and banks were left holding distressed properties. Large investment firms stepped in, purchasing homes in bulk at discounted prices. Supporters argued that these firms provided liquidity to a frozen market. They stabilized neighborhoods. They repaired abandoned houses. They turned them into rental units. According to reports at the time, investors framed the move as both profitable and practical. Demand for rentals was rising. Many former homeowners could no longer qualify for mortgages. The model seemed efficient. Capital flowed in, rental portfolios expanded. The idea looked modern, sophisticated, data-driven, but over time, a different narrative began to form. By the mid-2010s, according to housing studies and investigative journalism, institutional landlords had become dominant players in certain regions. In cities like Atlanta, Phoenix, and parts of Florida, large firms controlled significant shares of available rental inventory. Renters were no longer dealing with small local landlords. They were dealing with corporations. At the same time, housing prices were climbing. According to the Federal Reserve and independent housing analysts, home affordability steadily declined. Entry-level buyers faced intense competition. Reports showed that in some markets, corporate buyers made cash offers above asking price, often outbidding families relying on mortgage approvals. The pattern raised questions. If homeownership is historically one of the main paths to wealth building for middle and lower-income families, what happens when access narrows? By the early 2020s, the phrase Feudalism 2.0 began appearing in opinion columns and academic commentary. The term was not an official economic label. It was a metaphor. The comparison drew on a historical system where land was concentrated in the hands of a few, and many worked or lived on property they did not own. Researchers began studying the long-term impact of institutional ownership on rent levels and eviction patterns. Some studies suggested that large corporate landlords were more likely to file evictions than smaller landlords. Though the data varied by region, tenant advocacy groups reported difficulties negotiating repairs or payment plans with centralized management systems. Meanwhile, public trust remained divided. Institutional investors argued that they represented a small percentage of the overall housing market nationally. According to several real estate industry analyses, corporate ownership remains concentrated in specific neighborhoods rather than dominating entire states. They also noted that housing shortages, zoning laws, and construction constraints play major roles in price increases. But the numbers told a deeper story about concentration. According to wealth distribution data from the Federal Reserve, asset ownership in the United States has become increasingly concentrated over the past 4 decades. Housing is a major component of household wealth. When ownership shifts upward, wealth accumulation patterns change as well. At the same time, rising interest rates in 2022 and 2023 made mortgages more expensive for individuals. Large firms, with access to capital markets and institutional financing, were often better positioned to weather volatility. The system had evolved. Fewer people owned land. More people rented from centralized entities. Monthly payments flowed upward into investment portfolios rather than local households. Supporters described it as financial efficiency. Critics described it as a structural shift in power. And beneath the debate, one fact remained clear. For low-income renters, housing costs were consuming a growing share of income. According to U.S. Census Bureau data, a significant portion of renters now spend more than 30% of their income on housing, the threshold often used to define cost burden. The tension was building quietly. If ownership continues concentrating, and if rent becomes the primary path for shelter rather than ownership, what does that mean for economic mobility? Is this simply capitalism evolving? Or is this something closer to a modern version of land dependency? The rise looked orderly, but systems built on rising rent and limited ownership can face pressure. And when pressure builds in housing markets, history shows it rarely stays contained. The structure did not appear overnight. It formed step by step after the 2008 financial crisis. Private equity firms began experimenting with large-scale single-family rental portfolios. According to financial filings and investor reports, firms such as Blackstone created subsidiaries dedicated to acquiring distressed homes. These properties were often purchased in bulk from banks at discounted prices. The strategy relied on scale, centralized maintenance systems, data-driven pricing, professionalized leasing operations. Over time, the model matured. By the mid-2010s, several large real estate investment trusts were publicly traded, offering investors exposure to residential rental income. Quarterly earnings reports highlighted occupancy rates, rent growth, and operational efficiency. According to SEC filings, these companies reported steady increases in rental income as housing demand strengthened. On paper, the system functioned smoothly, but warning signs began to surface. Tenant advocacy organizations reported higher eviction filing rates among some corporate landlords compared to small landlords in certain regions. Academic studies, including research from housing policy institutes, found that institutional owners were more likely to use automated systems for rent collection and legal enforcement. While these systems improved efficiency, critics argued they reduced flexibility for tenants facing temporary hardship. Another shift involved pricing power. According to investigative reporting and class action lawsuits filed in recent years, some large landlords were accused of using shared data software platforms to coordinate rent pricing. In 2023, multiple lawsuits alleged that property management firms used algorithmic pricing tools that could contribute to higher rents. The companies involved denied wrongdoing, and the legal cases remain ongoing. However, the allegations highlighted a growing concern. When a few firms control large inventories and use similar pricing models, competition may narrow. Meanwhile, first-time homebuyers face new barriers. According to the National Association of Realtors, housing inventory in many U.S. markets reached historic lows in the early 2020s. Limited supply combined with high demand drove prices upward. Institutional buyers were not the sole cause. Construction shortages, zoning restrictions, and demographic trends all played roles, but their presence intensified competition. In certain neighborhoods, the pattern repeated in parts of Canada and the United Kingdom, where housing affordability became a political issue. Government reports acknowledged rising investor ownership as one contributing factor among many. As ownership consolidated, wealth concentration deepened. According to Federal Reserve data, the top 10% of households hold the majority of wealth in the United States, and real estate remains a core component of that wealth. Renters, by contrast, accumulate less equity over time. Monthly payments build landlord portfolios, not tenant assets. This is where the Feudalism 2.0 metaphor gained traction in academic debate. In medieval systems, land ownership determined economic power. Those who controlled land collected rent or labor from those who depended on it. Modern economies are far more complex. Workers are not legally bound to property. Mobility exists. Markets operate globally, but the parallel drawn by some economists focuses on dependency. If housing, the foundation of stability, is increasingly controlled by financial institutions, and if wages do not rise proportionally with rent, dependency increases when large portions of income flow to centralized property owners. Upward mobility can slow. The warning signs were not dramatic collapses, they were structural indicators. Rising rent-to-income ratios, growing eviction filings in concentrated markets, declining homeownership rates among younger generations, longer rental tenures. According to U.S. Census data, homeownership among adults under 35 remains below historic peaks seen in prior decades. Student debt, wage stagnation in certain sectors, and rising home prices all contribute. Institutional ownership is one factor within a broader affordability crisis. Defenders of large-scale landlords argue that rental demand reflects changing lifestyle, preferences, and economic realities. They point out that renting offers flexibility. They note that large operators can maintain properties at scale and improve housing quality. But the central question remains unresolved. When shelter becomes primarily a financial asset class rather than a pathway to ownership, who bears the long-term risk? Housing markets are cyclical. When interest rates rise sharply, as they did beginning in 2022, affordability tightens further. Mortgage payments increase, construction slows, rent pressure intensifies. If the system depends on ever-rising asset values and steady rent growth, it becomes sensitive to shocks. And history shows that housing-driven economic models can unwind quickly when stress accumulates. The mechanism appeared stable, but beneath it, pressure points were forming. The pressure did not explode in a single dramatic collapse. Instead, it showed up in policy debates, lawsuits, and public frustration. By 2022 and 2023, housing affordability had become a dominant political issue across North America and parts of Europe. According to U.S. government housing data, median home prices rose significantly over the previous decade, while wage growth lagged behind in many sectors. Rent increases in several metropolitan areas outpaced inflation during certain periods. Particularly after pandemic-era migration shifts, lawmakers began asking direct questions. In the United States, members of Congress introduced bills aimed at limiting institutional purchases of single-family homes. Some proposals sought to increase transparency around large-scale ownership. Others focused on expanding affordable housing supply or strengthening tenant protections. None fundamentally dismantled institutional ownership, but the scrutiny marked a shift in public awareness. Regulators also took notice. In 2023, the U.S. Department of Justice filed an antitrust lawsuit related to alleged rent price coordination software used by property management firms. According to court filings, investigators examined whether shared pricing data could reduce competition. The companies involved denied that their practices violated antitrust laws, and the case remains ongoing. Still, the investigation underscored growing concern about algorithmic influence in concentrated housing markets. Meanwhile, eviction data became a focal point. According to reporting by housing research groups, eviction filings returned to or exceeded pre-pandemic levels in many cities. Once temporary moratoriums expired, tenant advocates argued that large corporate landlords were quick to pursue legal remedies for missed payments. Property management firms stated they follow lawful procedures and emphasized that most tenants remain current. The broader economic context added complexity. Rising interest rates beginning in 2022 slowed home sales, but also locked many existing homeowners into low-rate mortgages obtained during the pandemic. According to housing economists, this created a lock-in effect, further reducing available inventory. With fewer homes on the market, prices remained elevated despite higher borrowing costs. The result was a narrowing path to ownership for lower-income households. The margin tightened further. According to Federal Reserve surveys, a significant share of Americans reported difficulty covering unexpected expenses. When rent consumes a large portion of income, savings accumulation slows. Without savings, home down payments become harder to achieve. At the same time, institutional landlords reported strong rental demand in earnings calls and financial disclosures. Some firms adjusted strategies, slowing acquisitions due to higher financing costs. Others diversified portfolios. The system adapted rather than collapsed, but long-term questions remain unresolved. Historically, broad homeownership has been linked to wealth building in the United States. According to government studies, housing equity represents the largest asset for many middle-class families. If ownership continues concentrating upward, wealth gaps could widen further. However, experts caution against oversimplification. Housing affordability is influenced by zoning policy, land availability, construction costs, population growth, migration patterns, interest rates, and global capital flows. Institutional ownership is one element within a much larger framework. In many regions, supply constraints, not solely investor activity, are the primary driver of high prices. Still, the structural shift toward financialization is widely acknowledged. Housing is increasingly treated as an asset class for global investment portfolios. Pension funds, insurance companies, and private equity firms view rental income as stable, inflation-resistant revenue. According to financial analysts, this trend is unlikely to reverse without major policy intervention or economic downturn. The phrase Feudalism 2.0 remains controversial. Modern economies provide mobility, legal rights, and labor markets that differ radically from medieval systems, yet the metaphor persists because of its focus on land control and dependency. When rent becomes a lifelong obligation rather than a transitional phase, economic mobility slows. When ownership concentrates, influence follows. The system has not collapsed. It has evolved. Whether that evolution ultimately harms or adapts to protect lower-income households depends on policy decisions, housing supply expansion, wage growth, and regulatory oversight in the coming decades. For now, The tension remains. Housing, once framed primarily as shelter and community, now sits firmly at the center of global capital strategy, and the question continues to surface in economic debates worldwide. If access to land defines stability, who controls that access in the 21st century? The answer may shape the future of economic mobility for an entire generation. If you found this investigation useful, subscribe to the channel for more deep dives into the financial system shaping modern life.